Housing starts lower month over month, but beating expectations this morning. That said, the rate on a 30-year fixed remains right around 6.7%. Here to break it all down and what it means for prices, HousingWire analyst Logan Mohtashami. Logan, there was so much hope that the Fed was finally going to start cutting rates and mortgage rates would continue to come down, and yet they've gone up along with the 10-year post-Fed cut. So what does this mean?
It's been very confusing for the consumer because they see progress being made on inflation, the labor data getting softer, and they naturally assume that mortgage rates will go sub 6%, which would be beneficial for housing. But we just don't have that kind of policy out there. I've tried my best to try to temper expectations, but unless the Fed comes out and tells people we're not in kind of the pro-growth housing stage of monetary policy, things will get a little bit clearer. But the economic data had been firming up. Bond yields shot right back up. Mortgage rates shot right back up. So this is what it is.
So what does that mean for activity? What are your expectations for where we go in the next few months?
We had a good 18 weeks of purchase application data. Rates shot up. It's going to go negative. This is what it's been like for the last 2 years. We're trending at the third lowest, at the lowest levels of sales ever in history for the third calendar year. If mortgage rates could just get to 6% and stay there, we can grow sales from these depressed levels. But the purchase application data has been very clear. We're at record low levels. Any growth we get here is minuscule to the big housing picture that we've had over the last 20 years.
Logan, help viewers remember some of the issues we might face. We got starts today and what we might get in multifamily next year in the way of pipeline.
Most likely, we're not going to get any housing construction boom whatsoever. Multifamily permits are at recession lows. The units are being completed right now. Once that is done, those people aren't going to be working on anything new. So it's a positive that we're getting some construction built now, but permits are at recession lows. If rates go higher, single-family permits will fall again. That's the problem. We just don't have that kind of monetary policy yet to be kind of pro-housing until the labor market gets weaker.
So you're not optimistic we're going to get more supply. You're not optimistic we're going to get more demand. So does that mean you expect prices to stay stubbornly high?
You know, inventory has been able to grow this year. 40% of the inventory growth in America is really Texas and Florida, but price growth is cooling. That's a positive. So it is a positive story that active inventory is growing this year. The price growth is cooling, but we need rates to stay at 6% and stay there. Whenever rates shoot right back up, it doesn't work for the housing market. It's just as simple as that.
Do we need more federal policy, the likes of which some of the presidential candidates are talking about, and when it comes to intervening on supply and incentives, both on the buy side and on supply and demand side?
Sympathetic to the view that housing sales are so low that you need to do something. I am not a big fan of any kind of demand stimulus. Literally all we would need is mortgage rates to get to 6% and stay. And then maybe single family permits can grow. The Fed funds rate probably has to go a little bit lower to get more multifamily construction and land purchases going. There's just not much going on here because policy is still restrictive for housing. For the economy, it's still expanding, but for the housing market, it's still very restrictive.